the typical long-term care policy, how it goes into effect, how they're going to pay you some money is when you cannot do what's called a key daily activity. So the key daily activities from almost all policies are dressing, in other words, being able to dress yourself, bathing, being able to bathe in yourself, toiletry, meaning going to the bathroom, transferring. Transferring means moving from a chair to their bed, from your bed to a chair, that type of thing. Eating and continence. So what long-term care policies typically say is if you cannot do 2 of these 6 activities, the long-term care policy kicks in and your coverage they will start paying based on some other criteria that you do have. That's what kicks in having the coverage. Obviously, if things like Alzheimer's come in, etc., those sort of are an umbrella above all of these things. But so this is the core way that policies kick in. Now, somebody earlier said they already have a policy. If you bought a policy a long, long time ago, probably over about 20 years ago, some of those policies say that you must be hospitalized for 3 consecutive days and then not be able to sort of take care of yourself. It's not as specific as these, but most policies over about the past 20 years or so will say it's depending on 2 of these 6 activities. Once you cannot do 2 of the 6 activities, the policy kicks in. They may ask for, if you go to claim the policy, they may send a nurse to your house, or they may ask for your doctor's records to be able to establish whether you can indeed not do at least 2 of these activities. So these are the things that typically kick in the policy or trigger, so to speak, the coverage. So that's pretty standard with all the policies that I said have been probably purchased within the past 20 years or so. So here's where some of the variances start. Some policies say that, most policies do say that the care now can be provided in your home or in a facility such as assisted living, nursing home, or hospice. Again, the real old policies, older than about 20 years ago, you had to go into a nursing home, was the only way coverage was afforded. That is not the case for almost all the relatively new policies. And like I said, just needing the care is the typical trigger, not where you go. So you can stay in your house, you can do assisted living, nursing home, hospice, any of those will typically kick in the coverage. This is one of the things you want. If you haven't purchased it yet and you're thinking about purchasing it, you want to make sure you understand that. Some policies will even say that you can have a family member take care of you and they will pay for it. Other policies will say that you need to have a licensed medical provider or a medical service provide the service. Doesn't have to be a nurse, but you would go through a provider that has licensed people. So these are some of the variances that you want to know, especially if you are looking to purchase a policy. If you do specifically intend to maybe have a family member, it's talked about they would be willing to provide care, you want to make sure you buy a policy that would pay for a family member having care. If that's not the case, or you don't care so much about that, then obviously it's not something you need to worry about. A lot of this, and this goes a little bit to Koya's question, is, you know, how much, what your financial situation and what your financial assets are. So you want to make sure you understand the coverages. And so I'm going to talk a little bit more about that here. Here are some of the topics to consider. Where can the care occur and by who? So we just talked about that before. It can happen in your house, and can it be with a relative or not? It does have to be somebody licensed. When to buy it. This was something else that Co asked. I'm going to show you a little table in a few minutes, but you can buy it at any time. However, your health status has a lot to do with that. If you are in very poor health, it's going to be almost impossible to get long-term care insurance, or it's going to be very, very expensive. So it's a fine line of when you buy it. Typically, as we're going to find out in the chart, the highest percentage of people buy it between about 55 to 65 years of age. Some people buy it earlier than that. Some people buy it later than that. So the earlier you buy the coverage, the cheaper the monthly payment's going to be because you're paying it for more years. Insurance is co-referenced. He referenced it's, he talked about they have, lawyers and all that too, but really what insurance really is, it's the law of, it's a financial, it's a number, it's a law of averages, right? They know on average, people are going to live, females are going to live to a certain age. Males live to a certain age. And it's basically a law of averages in regards to what's going to happen. They don't know who is going to need, when they're setting the premiums, they don't know who is going to need health care, who is going to need the long-term care insurance, who isn't, of the people to buy it, but they know pretty much what percent. They know that approximately 50% of people will need it and buy it in a certain age range. So that's how they help to set the coverages they have. And again, if you have a lot of companies will ask for the history of your family's health as co-referenced, and they'll use that information also. So another thing that really affects your premiums is what's called the elimination period. And this is sort of like a deductible on your car insurance or your homeowner's insurance. The deductible, you pay the first $250 or you pay the first $500, whatever. An elimination period means once the coverage kicks in, once you can no longer do 2 or more of those 6 daily activities, how long before the coverage starts paying? So typical elimination periods you can buy are 30 days, 90 days, 180 days, and 365 days. So the most typical ones are 90 and 180 days, but you can buy any of those. So what that means, let's just say that, Co, if you don't mind me just using your name, let's say that Co tomorrow cannot do 2 of those 6 daily activities, and he has a 180-day elimination period. That's really 6 months. So that means for this first 6 months that he can use that policy, this is like his deductible. They will not pay anything because he has a 180-day elimination period. If he'd purchased a 90-day elimination period, they would not pay for the coverage for the first 90 days, and then it kicks in at day 91. So the elimination period, the longer it stretches out, i.e. 180 days or 365 days, something like that, your premiums will be lower because the insurance is not going to start paying as early as if you get a 30 or